Welcome to another session of Value Investing webinar. Today, we are going to talk about how to deal with the cyclicality of the market. This is something which you can take it as guaranteed. Markets are going to be cyclical. Extremes of greed and fear will prevail, and you don't have a choice. You have to deal with it. And sometimes, there is a basis to all the extremism which we see in the market. Complete, bravery. Without a reason, things could be richly valued, and still investors will be, coming in hordes. And then we will see that things are attractive, things are cheap, and people are unwilling to take a story. And this is likely to prevail. And many a times, these are baseless. Many a times, there is a basis to it. How to profit from this? How to profit from the cyclicality? And how to evolve yourself to build a framework so that you can benefit from this cyclicality. To talk about this, once again, we have Nilesh Shetty from Quantum Asset Management. He's a portfolio manager. And you have been doing this for a while now. How do you deal with it? And what do you have to share, that how should we prepare ourselves to deal with this extreme madness of the market?
Yeah, so the core belief in terms of when we go and value companies is the belief remains that there is a business cycle which always plays out, irrespective of whatever the companies tell you. What has happened over the last couple of decades is the natural business cycle has been sort of tinkered around with by central bankers, and which sort of creates these extremes of overvaluation and sort of sharp collapses. And you add to that investor greed and fear within those sort of overextended valuations, and you get even hyper-extended sort of bull runs and dramatic collapses. And within that, what you're trying to do is trying to value businesses in a normalized environment. So whenever we look at companies, we sort of get it back to the mean in terms of what is the long-term cycle of a company, and then where is the company right now in terms of in that business cycle, and where is the valuation compared to that.
You are getting into a very, very nuanced and very, sophisticated argument. But I would just like to get a sense from you as a prelude to this discussion. That do you think that the cycles are becoming much more extreme and much more sharper, in a sense that two things which we know that has affected our thinking is the emergence of the media. We are so much more connected, and we are knowledgeable about things in the real time all over the world, which wasn't so. 20 years back, 15 years back, 10 years back, it wasn't so. So, a shipment of oil from some place or something happening, and we know it in real time in 15 minutes, somebody tweets it from there that there is a fire on this rig, and so information and the media. So do you think it has fundamentally altered the way we are, looking at things, or the way we are reacting, or the market's behavior?
Well, it has, because sort of human emotions tend to sort of value near-term news flow a lot more than sort of long-term trends. And there are biases. So recency or anchoring to near-term news flows in that sense. Unfortunately, most of the news flow that comes out is just noise. It doesn't impact long-term trends that dramatically. But human emotions are human emotions. We tend to place a lot more value on recent news flows and react according to that, which creates extremes of huge optimism or sharp collapses or deep pessimism when we try and look at companies. While reality could be something else. But it has sort of made an impact in terms of how we look at businesses and how we react to news flows because of too much overload of information. At least our sense is most of it is just noise. It doesn't impact long-term trends.
Do you have any checklist for filtering noise and fundamental news?
So you have to, for us, we go...
subjective thing.
Yeah, it is a subjective thing, and we go back to asking how does it impact the company's business, that news flow. Most of the time, in fact 99% of the time, it doesn't. A lot of it is sort of, it might have near-term repercussions where it gets impacted by 1 month, 2 months, or maybe 6 months or 1 year. But long-term trend, by and large, does not get dislocated unless something extreme happens in the business model or the value chain. And so most of the time, the answer comes back is it doesn't get impacted dramatically in the long term. And so that is how we sort of do a basic cross-check whenever we get such sort of extreme reactions in the market.
So how do you deal with it, besides doing the pranayama and the yoga and stuff like that? But how do you get focused, and how do you prepare yourself, or your team to deal with it? Do you argue among yourself?
So, I mean, the research, one of the big advantages for us has been our focus, where we are not looking at next 6 months or 1 year when you're doing research. The analyst is asked to look at 5 years and 10 years when he's building research models. And once the time horizon changes, you'll be surprised what kind of things the analyst starts looking at. And all these near-term numbers, be it next quarter earnings or next 6-month earnings, is not something that they're bothered with. So for us, just the change in time horizon and the requirement for the analyst to look at slightly longer time horizons when they're modeling companies suddenly sort of throws up different risks.
The attitude changes.
The risks that they think people should look at suddenly are something else than what the market is worried about.
So do you have a dealing room where you have the TV which is on, which has CNBC or some business channel always on?
Yeah, so we have one room where the dealer sits who executes the trade. That is the only TV in the company, where there is one TV. But most of the analysts don't have access to it. So most of the companies actually cut off from. In fact, a lot of...
So you keep off from that particular, the ball by ball commentary which is on all the time.
Yeah, especially given our understanding, most of it is noise. It's meant for traders as such, not long-term value. Sorry, investors, especially value investors as such. Yeah.
So how to deal with it?
Yeah, so like I said, one is, of course, focus on the long term and keep asking yourself in terms of, does this news have any major implication on the business of the company? If it doesn't, then the company is not impacted much by the news flow. And then for us, when we look at the companies, we are trying to forecast 5 years, 10 years, and we keep asking this question: where will this company be in 5 years, and where will this company be in 10 years? And it could sort of overextend or underextend within that cycle, which would have repercussions on valuations. But as long as that trajectory is not impacted, we sort of try and value that company based on that sort of steady trajectory that it is, trying to normalize. So if it's a bull run, we try and normalize it to get it back to the long-term cycle. And if it's a bear run or the company is going through a downturn in demand, we again get it back to its long-term cycle. And our valuation metrics are actually based on those sort of steady long-term run rate that we think the company is capable of. And then we wait patiently for the company to come to our valuations. That's sort of the only method that we figured out.
When you're waiting, or when your patience runs out, when does your patience run out? You run out of patience completely.
The question is, we go back to the research and keep asking them, have you missed something? And if the answer keeps coming back as no, then we continue to wait. Rarely does it come that we miss something and we need to change our assumptions.
But the market may not notice for a very long time.
Yeah, it does. But like I said, at least given the value style, the strategy is downside protection first. You don't want to lose money in the market, which is sort of Buffett's rule number 1. You don't want to lose money in the market. And in that sense, it's okay if the market doesn't agree with us. We'll wait and we have our views, as long as we have valid reasons for those views.
So all that you do, how can an individual investor benefit from the thinking that you have evolved or what you have followed? Any lessons that you have?
A good starting point is stop looking at all these news channels day to day. Perhaps getting away from the noise sometimes is helpful. Again, that rule that we have is try not to lose money in the markets first and then try and sort of making long-term returns. Perhaps that is a very simple and safe rule to follow, which the best investor in the world has followed that and made a lot of money. And for us, for a retail investor, again, just sticking to a long-term systematic allocation plan in terms of what he's trying to save for, and then sticking to that over a long period of time and not getting bothered by a lot of news flow in terms of panic and bull runs and optimism. Perhaps that is what has worked best for investors.
No, but the first thing which you said in the earlier part of the question is that having the long-term orientation. The moment you think in terms of 5 years and 10 years, your thinking changes and you start looking at news differently. That how does it matter? You made an interesting point about avoiding losers, not lose money. How do investors spot them? Any red flag that you see or which you would like to share, that this is it. You did not anticipate it, but it has, now you're staring at it. How do you spot them?
Yeah, for us, one of the big problems of investing, which people have found out, is recognizing that you've made an error and then acting on that is a very tough thing to do for an investor. For us, if we've gone wrong in any research, the analyst is asking...
Just tell me, what about the kind of mistakes that you do? What could be the omissions? I'm curious to know, or is it something which changes over time?
No, a lot of it is sort of something that we missed that the company did
At the outset.
Or we gave too much leeway to the company and we thought it'll change. So there was a company, IT company that we invested in, who in before the Lehman collapse decided to take on debt and do a lot of acquisitions. For us, when we bought into that company, it looked cheap, and when we kept on meeting the management, they sort of gave us great stories of how all these acquisitions were sort of going to do well and they were going to turn around. And despite the debt on books, we sort of gave it sort of a lot of leeway. And eventually we had to exit that company at a 90% loss. So sometimes just giving too much leeway to this management. Trusting management, despite the balance sheet telling you a different story.
But were you able to validate that? Did the management had a track record of executing things efficiently in the past before that?
So the pedigree of the management in terms of which group it had come from, so it was a subsidiary of a large group and they had built a decent business, but this particular subsidiary had not. So perhaps given the parentage, we gave it a bit more leeway than we should. But perhaps the financials were telling a different story and perhaps we should have acted faster in that case. But in this case, it was sort of, again, a mistake in research where the research should have picked it up earlier, saying that the balance sheet is deteriorating and perhaps we need to take a relook at what our assumptions were in this company.
Thank you very much for sharing this, and we'll get on to the questions which our readers have sent for you. Sandeep is asking, is the current slowdown in car and two-wheeler company due to a down cycle or a fundamental shift? How do you differentiate between both? A lot of talk about, the EVs and the ride sharing, Ola, Uber, we have just gotten used to it. So is it going to really have a fundamental shift? And this budget, the way it has given 1.5 lakh rupees tax incentive on the interest payment on a loan only for electric vehicle. It looks like we don't have electric vehicle, but we have the tax incentive available.
What has happened, there is a long-term structural story in EVs for sure. I think at some point lower-end cars in terms of sort of CC horsepower will get converted to EV very, very quickly. But it might take 10 years. Even the
it's not happening tomorrow.
It's not, and the existing players might be the sort of
leaders. India's story could be very different, no? Because it could well be about the two-wheelers.
Yes, it could be. The largest sort of electric two-wheeler population is in China right now. And there has been a sort of migration towards two-wheelers. The point is, the existing incumbents, are they capable of launching their own products in that space, and can they sort of create a market?
Sustain their leadership.
Yeah. So our sense is most of them are already sort of doing a lot of things on that side, and perhaps they might continue to sort of dominate the market. I think the slowdown perhaps the reader is referring to is what happened post-September, where suddenly two-wheelers, which were growing at close to 14% in H1, suddenly started reporting negative growth. And perhaps what has happened on the credit markets after IL&FS had some role to play in that entire slowdown. When you talk to all the companies, they don't sort of agree that credit markets have had a role, because the cost of availing a two-wheeler finance has not changed. It's still the same, and anybody who wants to buy a car or a two-wheeler
is not getting stuck for loans.
But our sense is perhaps a lot of ancillary things that were getting financed, be it SMEs or small businesses that were getting financed by a lot of these NBFCs, that has stopped. And demand that was being created by their employees, perhaps that is not happening right now.
General deceleration in demand.
So our sense is that is more cyclical. That is not a structural change. A structural change will happen when penetration levels reach a certain threshold, which sort of makes growth a lot more difficult to achieve. Which in India's case, in two-wheelers compared to Southeast Asia, there is still a long headway to go. And cars, we are not even close to anywhere close to penetration. This is a long, long way to go. So that structural story is not played out. Our sense is that is more cyclical in nature. But there is a long-term story on technology driven by EV. But our sense is the current incumbents are the ones making the major investments in India and have the distribution. Perhaps they again will be a big force in that space as well.
Okay, the next question about the cyclicality of the market, which is, Pranav, do market cycles have anything to do with the development stage of an economy? In other words, does a developing economy like India experience a different form of cyclicality than a developed economy like the US? I guess it should be, no?
Yeah, given the stage of economic development, so the ranges will be very sort of wider. So a developed market like the US, in a slowdown, they'll go close to 1% GDP growth, and in an upturn, they'll be sort of 3% GDP growth. That'll be a narrower range. Where India in a slowdown can fall to sort of 5 or less than that, while an upturn can go to 8. So the ranges become a lot more wider. Hence, the volatility of business cycles
Anything less than double digit, we say that, we are not growing well enough.
Yeah, given the stage where we are in. So it sort of creates a lot more volatility and a lot more sort of wider ranges for business cycles. But in our case, there will be growth for sure. It's not sort of given, but given the stage where we are in, we will continue to grow. Just the volatility in growth, given the numbers, will be a lot wider than in say, a more mature market.
Okay, Nitin is asking, are there sectors which are not cyclical? If yes, isn't investing in such sectors better than investing in cyclicals?
Yeah, so sectors which are very early in their development, new in their life cycle, they shouldn't be that much impacted by cyclicality, given that the sector itself is sort of being formed right now. But by and large, apart from that, I've not come across sectors which are not impacted by cycles. Some are less impacted and some are more, but by and large, all of them will be reacting to a business cycle as such.
Or there could be cycles which are global cycles and local cycles or things like that.
Yeah, absolutely. So every in sort of sector like cement, there could be regional cycles where some regions are in a downturn while other regions are in an upturn. But there are cycles which impact them. Some sectors less so, but so you will have less impact on a consumer staples company, while a more impact on a cement or a metal company when business cycles play out. But by and large, they do react to cycles. It's only companies where the sector itself is very new and nascent. So it could be sort of IT emerging out of a new sector altogether, or online retail when it was emerging. They would not be impacted that much by business cycles, given that it's a new sector being created.
Now we have got the mother of all questions, which is Yatendra is asking, what is your outlook for banking and finance over the next 3-4 years, and how much money we can make? How much money is actually the question?
Yes,
it is 1/3 of our Sensex.
It is, and I think most of the indexers are now worried given the quantum of weight that they carry. A lot of them are looking at capping weights for the sector now. But I don't know how much money can be made, but our sense is we'll get back to our long-term trend, which is roughly about 2 times real GDP growth in terms of credit growth in the system. Perhaps retail might continue to grow a bit faster, given that household debt remains very low in this country. But by and large, I think
corporate thing has turned out to be so distasteful.
It has, and I don't see that much appetite even now for banks to lend that much. Yeah. So, but by and large, we will get back to a long-term trend. We are already sort of getting close to that in recent numbers. But our sense is the credit growth in the economy will get back to sort of 15-16% long-term trend that it was. How much money that you make will be a function of which stocks that you have and valuations that you've paid. Even in the previous question, the question was, should we just be investing in those sectors? Yeah. Again, it's purely a function of the valuations that you want to pay for those sectors. It doesn't mean you will make money irrespective of the company not being impacted by business cycles. Similarly, in banks, if you're able to pick up a great bank at valuations that make sense, you will make money.
Yeah, so I'd just like to summarize what he said in a more direct manner, that there are, buying a great company at a fancy price won't be beneficial. And there are great companies in a lousy sector, and there are lousy lousy companies in a great sector, so to say. So be careful.
Yeah. Or to put another way, I think to give you an example that Ben Graham quote, not all great companies are great investments. Not all great investments are not great companies.
Yeah, I remember, Infosys, the great company, somebody bought it in 2001. After the Y2K crisis and the whole debacle, nobody made any meaningful money for next 10 years or 12 years. So buying a great company at a fancy price will not take you anywhere. Be careful about that. And we find, many great companies which are available at very fancy prices. Sanjeev is asking, how do you value funds behave in different market cycles? How do value funds behave in different market cycles?
So value funds by nature are meant to sort of protect downsides a lot better than sort of a growth fund. A growth fund by sort of definition is willing to pay a premium for companies which are growing fast. What it means is when the growth sort of slows down a bit, they can have sharp downturns in the valuations of these companies. While a value fund is trying to buy companies at a discount to its sort of intrinsic value, hopefully a lot of the companies have decent margin of safety. So whenever there is a market sort of correction or collapse, they should fall less. So what you will see in a value fund is when the markets are falling or the business cycles are turning down, their portfolios tend to do a lot better. While when there's a bull market on or when business cycles are booming and we are getting close to the peak, that time their portfolios will suffer because their companies will be growing a lot slower than the market in general.
Okay, Rishad is asking a very sophisticated question that is there a better indicator than PEG ratio to value a stock? Also, would it not be better to use growth of operating profit in the denominator instead of net profit? Because net profit may contain income other than businesses, other than the core business. But that is also income.
I mean, whatever works for, investor, there are a lot of things where you look at, people have sort of narrowed down to why don't we just look at cash flow, look at cash for the company generating, given that the income sort of includes a lot of things which are accrued and it doesn't generate cash as such. There is no set rule as such. Whatever
different things work for different kind of companies.
So, PEG ratio, just looking at the PEG ratios might not give you the best investment outcome.
Just explain for our readers' convenience,
so the PEG ratio is nothing but you take the price to earnings multiple of a company and you compare it with the growth of the company. So if the company is quoting at a price to earnings of say 12 times and the growth in profits is say 12% every year, then the PEG ratio is 1, given that the price to earnings multiple divided by the growth of the company. So the theory is that if the company is trading at less than 1, in that sense where the growth is faster than the price to earnings multiple, then you are essentially buying companies which are relatively cheap. And hopefully the growth continues to remain faster than the price to earnings multiple, the company will continue to get cheaper and the PE will expand at some point in time. But again, there is no hard set rule. You have to find out the reasons why the PEG ratio sometimes is trading at less than 1. You might be
The future earnings are always unknown.
Yeah, and the future, you might be sort of mispricing future earnings. There could be an earnings collapse coming in that company. But in a lot of cases in commodities, in fact, you might not even be able to get a PEG ratio. In fact, in commodities, when a business downturn happens, a lot of these companies turn into losses, but they might be trading at discount to replacement costs, and that is perhaps a good metric there. And in banking, a lot of people look at price to book, even though the book itself will have a lot of adjustments. So there is no set metric as such, but it is one of the metrics that you can look at to gauge valuation.
One of the inputs, yes. How do you spot a bubble in market or any stock in particular? What should an investor do in such situation?
For us, again,
I know what to do in such situation. If you're able to spot one, run. But how to spot one?
Unfortunately, most investors are trying to time the top, and most people believe that they will be able to exit at the top, and they just want to make a little more money, which is not the case. The way to spot a bubble is, one is of course the growth rates in general are much above the long-term median sort of growths that we've seen in a particular company or in a sector. And second is, if you add leverage to that, where you see a lot of people leveraging and making those investments in that company, that sort of overextends that valuation a lot more. The best thing to do in such a scenario is step away. Once you have your own sell multiple target and the companies sort of breeze that, exit and then step away and wait for sanity to come back. That is sort of what we've done over many cycles.
Keeping off for something which looks unusual
or relatively
on extreme range.
Yeah. And there are always stories that come in bull runs where how people will sort of peddle the thing that this is going to last forever.
This time is different kind of thing.
This time is different. But what we've seen is always the same. It's not different at all.
It's not different.
Yeah.
Oh, finally, Pradeep has sent a question for me. How does SIP in equity funds cover downside risks? It doesn't cover downside risks. Just that it helps you navigate through the risk. When you are doing your SIP, you feel happy when the market goes down because you are also going to invest in future, and it's a nice way. It's a convenient thing. You earn your salary every month. You pay your car installment every month. You pay your EMIs every month. Why not invest every month? And when you have some goal which is 5, 7, 10 years away, you feel happy that you are buying something cheap, and by just averaging your investment. The biggest advantage is that you eliminate the possibility of catching a market high, which translates into deep regret for investors. If you have 10 lakh rupees and if you invest tomorrow and the market goes down by 5%, you start relating that 50,000 rupees notional loss, even if you are investing for 10 years, that it would have taken you 3 months of savings, and or those kind of things. You start relating that amount of money to something more realistic. You have far more, you have greater regret. And investing in equity for individual investor is all about, navigating it in a manner that you can stick around for a long period and things get taken care of automatically. So that's all there to it. Form a habit. Now, I think this is a question which I would toss to you, which is Priyanka is asking, how do you compare real estate and equity mutual fund? Which will give higher return over the next 4 or 5 years? Oh, 4 or 5 years? No, I'll answer this. I'm tempted to answer this. I don't think of real estate as an investment. I think that you should buy a home, and you should buy a home with some kind of framework in mind that it is not going to consume. You should have a reasonable down payment, and you should not be spending more than 1/3 of your current income to repay any borrowing or any loan that you take for buying that home. And next, real estate and equity funds are very different. One is the ticket size, the scale of money that you need to buy a house. Then 4 to 5 years, maybe it takes 3 months to 1 year to conclude a transaction, and takes even longer, maybe sometimes if you're lucky, 6 months to 1 year to get out of a real estate investment. So unless you are thinking of 10, 15 years, 20 years, don't even think about it. And unless you have some specialist advantage that, you have access to a land or something which, where you think something will happen, which will, any such opportunistic thing. Except for that, I think for individual investor, real estate should be looked upon as a home, not as an investment. So thank you very much, Nilesh, for sharing your insights, and look forward to seeing you again with our next session of Value Investing webinar.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.